Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other sectors, other indexes within the stock market. We also look at other markets because sometimes we can get some clues as to what's happening inside the S&P 500 by looking at these other markets. This video is not necessarily meant to be used by itself. It's meant to go in conjunction with the other videos that I post. This is being prepared for Monday, March 11th. The first area that we look at is S&P 500 valuation. We look historically back at earnings reports that have already been released to see, is the market considered to be expensive, fairly priced, or inexpensive? And then we look forward to projections as to what analysts think earnings will be going off into the future. And we can also measure the market to see if it's inexpensive, fairly priced, or cheap. The first chart looks backwards. This is called the trailing 12 months. And what we do is we plot the S&P 500 in black right here. PE ratios use static numbers, 10, 15, and 20. When we're at 20 or above, the market is considered to be expensive. And by looking at this chart, we see the current price of the S&P is above the red dashed line, which is the PE ratio of 20. So on a historical basis, right now, we are considered to be expensive. We can also go back and look at other times, and the market spends a lot of time being expensive. We can also look at this down below. It's kind of a bigger picture look where we take the price of the S&P and then compare that to the PE ratio of 20. When we're above zero, that also means we're expensive. We can look at this in the context of different historical events that have happened going back to 1980 and what the valuations were at that time compared to where they're at right now. Another way of looking at this is to take it over a period of time, more of a smoothed effect, and this was developed by Robert Shiller with his PE ratio. This also is known as CAPE, C-A-P-E. And according to his calculations, we're at 34.24 right now. To get some perspective, we look at that on a historical chart to see what were prices during other times, like the 1929 crash, the 1987 crash, and where we're at right now. We can also look at this by calculating the median and the mean, and we're just under 16 for the median and just over 17 for the mean. So right now, we're about double the price when looking back at earnings reports to suggest that, yes, the market is overvalued at this time. But the market doesn't do that. The market looks forward. And so we have another chart here from Yardeni Research that shows the forward-looking PE ratio. The red line is the S&P 500, and we're coming in slightly over 20 at 20.7 as of Friday's close. To get a little bit of perspective, we can look at the mid caps and the small caps, and they're not as overpriced right now. They're around the 15 to 16 level when we look at the mid caps and small caps. The small caps have really been lagging behind, and they're still undervalued, where the mid caps did set an all-time high this previous week. And this is what the market really uses to justify prices going higher or feeling that they need to go lower. We don't use these different valuation charts to make decisions. We really just use them to get an idea of what's the overall context of the market right now. We use other tools to help us actually define when it's a good time to get in or get out. Another area that we look at is growth versus value. When growth is outperforming value, that really helps the market to go up. When value is outperforming growth, that usually means we're in more of a defensive posture and the market is either going sideways or actually declining. The first thing we look at is a pure growth index. This is just growth all by itself. And by using some moving averages, we can see that this is in an uptrend. We also look at value, which is also in an uptrend right now. Where this becomes useful is when we do ratios between the two. And I have a top chart here, which is growth to value, showing that growth is outperforming value. On the bottom is an inverse of that same chart, showing how value is underperforming growth. And that's more indicative of a more healthy stock market environment. The reason why I plot a number of different indexes and ETFs is because sometimes you can see where the calculation is a little bit off. when we had the moving average crossover here, we want to make sure if we're switching from a growth environment over to a value environment or vice versa, that we're seeing the same things at the same time to give us more confidence of what the market climate is actually like. This is a growth to value ETF ratio showing how growth is outperforming value. This is an inverse showing how value is underperforming growth. So we're seeing confirmation there. And we look at a longer term look at the peer growth indexes and take a ratio showing how growth is outperforming. And then this is a shorter term look at those same indexes showing how value is underperforming growth. Here's another look using some indexes showing how growth is outperforming. So we're seeing pretty much across the board right now that growth is outperforming value. This is an area that I watch pretty closely. I even watch this on an intraday basis because a lot of times when growth is outperforming value, that gives good support for prices to go up. And of course, the inverse of that is also true. Then we look at a little different way of measuring this. It's still a growth to value measure, but I'm using different instruments to do this. This is also showing that growth has been outperforming value and that value is underperforming growth. Then we break it down a little bit more. We look at just the small caps, and this has been rather encouraging lately. For much of 2023 and into 2024, we've been chopping sideways with this ratio when we look at the small caps. We finally are starting to break out. Unfortunately, we're not really seeing much of that in the index itself. The index has been improving, but it's the last major index that I follow that has yet to make a new all-time high. We also look at the mid caps, which is looking a little bit more robust right now with a more solid uptrend, even though it did pull back in Friday's session. And we're seeing a little bit more of an upward move with the mid caps, and we did set a new all-time high this past week. We look at S&P growth to value, and this is an end of day chart. This is the one that I probably focus on the most. When we see growth really outperforming value, that tends to really help the S&P go up. Now, there are times when value can outperform growth. That's when we see the ratio going down, and the index can still go up, but it has a tendency to stall and go sideways for a while and sometimes even pull back. When it's showing more strength is when we see this ratio going up as the index is also going up. We also want to keep an eye on inflation. This is a monthly chart of the CRB, which are commodities on top, and we pretty much have been going sideways right now. Then we take a ratio of inflation to deflation below. When this is going down, that means that inflation is going down and deflation is actually picking up. We want to keep an eye on this because we tend to like it when inflation is going down, and that helps the whole interest rate environment. But if this gets going down really in a strong manner, that means deflation is outperforming, and that could ultimately be worse than inflation. Here's a daily chart of the CRB index. Here's a breakdown of the different components of this index. And we're still in a longer term downtrend, even though the CRB index has been going back up. We haven't quite seen a golden cross yet. There's the Baltic Dry Index. This is what does it cost to ship products from one place to another. This is in a longer term uptrend and it has been going up lately. So this could be somewhat inflationary. Some other markets that we look at that we just check out on a weekly basis. Some of you may be involved in some of these markets. A lot of these are futures contracts. And we just want to keep an eye on this because a lot of these areas, when they're going up, that can be more inflationary. When they're going down, that's more deflationary. And right now, even though we're seeing close to a golden cross here with aluminum, it's still in a longer term downtrend, but it has been bouncing back up a little bit since the beginning of 2024. Here's corn, which is pretty much in a solid downtrend. Wheat is also in a downtrend. We keep an eye on fertilizer. That's kind of the bedrock of farming. And we were really coming down with fertilizer prices, but lately we've been chopping sideways and even seeing a bit of an increase. We want to keep an eye on oil because that affects all of us. We're still having a hard time getting above the 80 level. We've been chopping between the 70 and 80 level now for the last little while. Keep an eye on gas. Another thing that's really impacting a lot of people as they drive their cars. It has been going back up. We're still in a downtrend. We haven't seen a golden cross here yet, but it has been bouncing back up. Then we keep in a price we keep an eye on the price of diesel, where lately it's been going down. It started to go back up, fell, and it's starting to go back up again just a little bit right now. Here's heating oil, which here we are late winter. It's kind of nice to see this price going down a little bit. It's a little bit less to heat our homes that way. And natural gas has really been going down a lot lately. Copper, this is more of a barometer of the economy. When copper's going up, that tends to look more favorable at economic conditions going forward. When it's going down, that tends to mean that the economy is going to be weaker. We've really been chopping sideways lately, even though copper is still in a daily uptrend. We look at a copper to gold ratio, and gold has really been in the news a lot lately. It's starting to break out. It's setting all-time highs. The ETF that I'll show you later, it's been breaking out lately. And so when this ratio is going down, that means that copper is underperforming gold. This is a longer-term look at that same chart. The black line is the copper to gold ratio, and we plot that with the 2-year yield and 10-year yield. And there's quite a wide spread here between the two, where other times we see that they tend to not get all that far apart from each other, and they tend to go in the same general direction. Now we're kind of seeing them going in opposite directions as we're shifting into what potentially could be a newer or different phase of the economy. Here's the gold ETF, which really is starting to go up. It's kind of all the rage right now, and all the people that have sworn by gold forever, they're just really happy right now. The ETF tends to lag behind the futures contract, where we're just starting to go over 2,000, or on this chart, 200, where gold is a little bit higher than that just based on the futures contract. Silver, though, even though it had a good week this past week, is still in a longer-term downtrend. We look at the closing price of gold, where it's really been breaking out, and silver's been doing better as well. And they have a pretty strong correlated relationship, but silver's been lagging behind lately. And so we look at the gold to silver ratio, and typically when this is going up, that means that gold is outperforming. When this is going down, that means silver is outperforming. And then to try to get some insight as to what's happening with the US dollar index, we plot that in the middle, and we look at the correlation between the two, but it's pretty much neutral right now. So we're not really getting anything useful from this chart. Here's the dollar index, which has been strong since the beginning of 2024. Now we've been pulling back, and we're actually dropping below the moving averages, but we're still in a downtrend. And this has been giving some support to stocks, because stocks tend to like a weaker dollar. The conversion rates are more favorable, and the import-export calculations are usually more favorable for stock prices. We want to keep an eye on the euro. That's what's plotted up above compared to the US dollar index. We also keep an eye on the Japanese yen. Then I have some breakout charts showing the euro to the dollar, where it was really going down for a while. Now it's starting to go back up, but the euro is still in an uptrend when compared to the dollar. We did see a bounce up with the Japanese yen. There's been some talk about interest rate movements in Japan, and that's been giving a little bit of support to the yen, but it's still in a longer-term downtrend when compared to the dollar. The British pound is also continuing to be in an uptrend when compared to the dollar. Different indexes, and I show this in every daily video. We're seeing a real improvement with the S&P equal weight index. The S&P 500 itself is a weighted index, so the bigger stocks have more of an impact on how the index moves. Well, since that may not be considered fair, they have another index that's an equal weight index, where every stock is treated the same. That's the red line that you see here. And it also set a new all-time high this past week and has been showing some improvement, which is suggesting that we're seeing more broad participation as stocks have been going up. And we look at another ratio. This is the equal weights S&P 500, where when this is going down, that means the equal weight has been underperforming as the S&P has been going up. But we've been seeing a little bit of a bounce here lately, but still it's the big companies that have been having more of an impact on the indexes. This is a ratio from the S&P 500 to the CRB index. So we're comparing stocks with commodities, and this is showing how stocks are outperforming. Here's an inverse of that same chart, also showing how commodities are underperforming. The NASDAQ 100, which is pretty much all big growth tech companies, and the S&P 500, both have been setting recent new all-time highs. And we've seen a bit of a pullback lately, but in the bigger picture, the NASDAQ 100 is outperforming the S&P 500. This is a ratio from the S&P 100, the biggest stocks in the S&P 500. Even though it's been pulling back, they still have been outperforming. The bigger stocks have been outperforming the rest of the S&P 500 index. The NASDAQ and the S&P 500 both have been doing really well, but the NASDAQ continues to do even better, also setting recent all-time highs. The NASDAQ 100 and the NASDAQ showing a little bit of a pullback now. There's a few of the big Magnificent Seven companies like Apple, Tesla, and Google that are under some pressure right now, and that's putting a little bit of pressure on the NASDAQ 100. But longer term, the NASDAQ 100 is outperforming the NASDAQ, even though both are doing well. Here's the mega cap, and then we take a ratio with the S&P 500 equal weight index, where it's still in a longer term uptrend, even though lately it's been pulling back as we're seeing more broad participation in the upward move. And this is small caps. This has been a real area of disappointment, and it's kind of unsure right now. The debate is going back and forth. Is now the time to get into small caps? Well, when you look at this ratio between the small caps and the S&P 500, that's the red line. They're still really underperforming here. And it's showing that on a relative basis, small caps are just not really showing any strength yet. Here's another look at that same thing. This is another ratio showing that on a comparative basis, small caps continue to underperform. So it's not really showing any strength right now. We don't know if that weakness is going to continue or if we're going to see some kind of a bounce from this ratio. The biggest software companies are in a longer term uptrend. They're not back to their all-time highs yet, but they're hanging in there for right now. Here's mega cap. This is what everybody's talking about. Even though they pulled back a little bit later in the week, they're still in a really solid uptrend and setting recent all-time highs. This is robotics and AI, another big buzz thing that's happening right now. This is seeing a real solid up move when we look at this by itself, and it is starting to show some improvement when we do a ratio with the tech sector. It had been really underperforming since the beginning of 2024, and with NVIDIA and semiconductor-related companies doing really well, we're seeing this really start to show some improvement. This is the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. This is in an uptrend, but pretty much all of the strength is coming from the Dow. The transports are really underperforming, that I'll show you later, and the utilities are in a downtrend as well. So the upward move that we're seeing is really coming just from the Dow itself. This is the S&P 500 and comparing it with 1 to 3 year bonds, showing that stocks are outperforming bonds by looking at this ratio. Then we look at a broader measure, the S&P 1500, and also compare that with shorter term bonds. This also suggests that stocks are outperforming. Here's another broad market measure, and then looking a little further out at bonds, also showing that stocks continue to outperform. This is a total U.S. stock ETF, which includes 2,651 stocks. This is just coming off of setting recent all-time highs. This is also suggesting that there's more than just 7 stocks that are participating. Now, when it comes to market capitalization and their impact on the indexes, yeah, the Magnificent Seven really have an impact, but this is showing that all of these stocks together are in a pretty solid uptrend. These are low volatility stocks, which tend to do better when the market's under pressure, but lately, since the beginning of 2024, they've been in an uptrend. However, when you compare it to the performance of the S&P 500, the low volatility stocks are really underperforming. The tech sector, and then looking at 3 to 7 year bonds, shows that tech is outperforming bonds. And then we look at some other stocks, and I show this in the daily video as well. This is an advanced decline line studies across the market. This is NYSE common stock, where we're breaking out and setting new highs here. We're also setting highs with the S&P, the mid caps just coming off of setting a new high. And the small caps, they're improving, but they are continuing to lag, and they haven't been able to break out above these recent highs that were set. We look at Dow theory, and the Dow is doing quite well. Even though it's off of its all-time high, it's been performing rather nicely. The transports have been chopping sideways, and they're continuing to underperform, where utilities have been under quite a bit of pressure. We look at the transports just by themselves, where you can see they're chopping more or less sideways. We've not been able to do or get any kind of a breakout here based on the high that was set in late 2023, another high that was set in 2023, and the all-time high set back in 2021. This would be more healthy for the market if this could really start to go up, but it's just not doing that. Here's a ratio of the transports to the S&P, and this just keeps going down, 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 showing how transports are underperforming. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and it's coming down a little bit here just over the last few days, but overall, the Dow continues to outperform. And we look at the relationship between the S&P on top and the transports, showing that they don't have a real strong correlated relationship right now. The higher this reading is, the more they're having a tendency to go in the same direction at the same time. And we're seeing the S&P going up, but we're seeing transports going sideways, and that's why we're seeing a pretty low reading with this correlation. Then we look at a new take on Dow theory, where traditional Dow theory uses the Dow and the transports, and some folks also include the utilities. Well, maybe that's a little old. Maybe we need to change that. And instead of using a Dow, we use the S&P. And instead of using the transports, we use the NASDAQ. Well, finally, we've been seeing all-time highs set with the NASDAQ, also being confirmed by the new highs set in the S&P 500. So based on this study, this is a confirmation, and that's what you want to see. That's part of Dow theory. When one index is making an all-time high, you want to see the other indexes doing that as well. This is a little bit different slant, where it's another take on Dow theory, where instead of using the S&P 500, we use the equal weight S&P 500, which is setting recent all-time highs. And then we look at an equal weight of the QQQ. So this is breaking it down to the NASDAQ 100 and then treating all 100 stocks the same. This is all also just coming off of setting recent all-time highs. So we're looking pretty strong, and we're seeing confirmation there. I didn't use this chart for quite a while because last spring they changed how the Wilshire 5000 was calculated, and I wanted to give it some time. They gave it a new symbol, and this is more of a broad market measure, where typically I use the NYSE composite. This also gives us a pretty good look at the whole market altogether, and this is showing that we're in a pretty long uptrend. Here's the FANG index: Facebook, Amazon, Apple, Netflix, Google, the Magnificent Seven, and some other stocks. They continue to hold up really well, even though lately they've been chopping sideways. And then if we do start to fall with the FANG index, we'll be looking for other areas of support. I have a few lines here right now. If we do start to develop some weakness, we'll be looking at some of these areas to see if they do end up providing a support level. ARK, which is a very popular investment, is still in a long-term uptrend, but it's not really been participating with the rest of the market lately. Then we have a monthly chart of the S&P 500, and we do a ratio with global stocks that are in Europe, Australia, Asia, and the Far East. When this is going up, that means, excuse me, that means that the S&P 500 is outperforming the rest of the stocks in the world, and we're above an advancing moving average. We can also plot that on a momentum basis, showing that the momentum continues to be positive. Then we look at bonds. This is the total bond ETF, where we're falling back since the beginning of 2024, but we're still in a longer-term uptrend. And this is bonds based on price, not on yield. We also look at a world bond index, which has been really choppy lately. It's still in an uptrend and trying to bounce back up, but this has been a lot more volatile than the other bond ETF that we follow. This just shows on a monthly chart that stocks continue to outperform bonds, even though it did tick down recently. This is a daily chart showing how bonds are underperforming stocks. So on this previous chart, that's a long-term chart. Here we have a short-term chart, so that's more of a confirmation. Excuse me. And then if you watch the weekly video, I have a weekly version of this chart, so that gives us more of an intermediate look in between these two charts. These are high-yield corporate bonds. You also may know them as junk bonds. They continue to be breaking out and setting all-time highs. Investment-grade bonds are more conservative. They're also in an uptrend, but still have a long ways to go to set all-time highs. This is a ratio between riskier bonds like junk bonds and more conservative bonds like government bonds. And when this is coming down, that means that folks are having a tendency to get out of the riskier bonds because they think maybe interest rates have topped out and they're going to get more into conservative bonds with a higher yield that they're going to lock in for a longer period of time. We've seen this come down before only to turn and go back up. We're going to be watching this to see if this ratio does continue to fall. Then we look at a correlation between stocks and bonds. They're having a pretty strong tendency to go in the same direction. So if stock prices are up, bond prices are probably up as well, and the inverse of that is also true. This is the Dow Jones Corporate Bond Index, which is also in an uptrend. It had seen some weakness, but now it's been starting to bounce back. Here's a Fibonacci chart of the 10-year yield, where last October we hit 5%, and then we were coming down with interest rates. That's when we saw a really solid up move in stocks. Now we've been seeing interest rates going back up, but lately they've been starting to come back down. And in this past week, that was giving some support to stocks. This is a longer term look at the 10-year yield, where for 40 years, we were seeing a series of lower highs and lower lows as interest rates are going down. We're possibly seeing a shift now as we go into what could be a higher interest rate environment. This is a chart that I've been showing for quite a while. This goes back to last October when we hit 5% on the 10-year yield. And at that time, the reason everything shifted is some really good thoughts were coming into the market that it looks like we're going to have a soft landing, which means that we might see some economic weakness without going into a recession. This is when the market was really picking up on the idea that the Fed may be cutting interest rates. And so we turned and started to go in the other direction. Well, that's positive news. The reason I keep showing this chart is the other times we saw really low readings here. This was during the Euro crisis back in 2011. This was during the COVID lockdowns. Those were both negative things, and this is taken as positive. And it's like, okay, that's not normally what we see here. What we're really watching right now is what's happening in the banking areas, specifically the regional banks. There's New York Community Bank, which is under a lot of trouble right now, and their stock price has just been getting hammered. We're waiting to see if other banks are going to start to say we're having problems too. That's kind of how the great financial crisis started, in that kind of manner. And we're just wondering. Now, we're not seeing anything like that yet, but we just keep watching for that just in case it does develop. Here's the 30-year yield, which really isn't near any of the Fibonacci retracement levels right now. This is a ratio between stocks and the 10-year Treasury yield, showing how stocks are outperforming the rise or fall in interest rates. Here's the 3 to 7-year bond, and then we compare that with stocks. This is similar to some other charts that we were looking at. When this is going down, that just means that bonds are underperforming stocks. Junk bonds continue to hold up quite well, and they're getting really near, if not hitting, new all-time highs with this ETF. We look at a ratio showing how junk bonds are outperforming government bonds. When we start to see this come down, that could mean that interest rates have topped out. Folks are getting out of junk bonds. They're locking in longer rates with more conservative and safe government bonds. And if we see this really start to fall, that may be what's happening. Here's just a look at the 7 to 10-year bond ETF, which continues to have the momentum that's positive. It's also in a longer-term uptrend, and when we look at the RSI, it's above 50. So bonds based on price are positive right now. This is a daily chart of the yields, where when we hit these high levels and started coming down, that was in October, and this was giving a lot of support to stocks. We were going sideways, and then for a while, we saw interest rates going up, and stocks were going up at the same time. But lately, now we're starting to see interest rates coming back down, and that's been giving more support to stocks. This is a weekly chart looking internationally, where we have the US, UK, and German rates, which did decline this past week. The red line is Japan, and they were flat on the week. We look at the MOVE index, which tries to measure the volatility of bonds. We look at the VIX, which measures the volatility of stocks, and their correlation is not really, in fact, they're having a tendency to go in opposite directions right now, as the market is adjusting to what it thinks the Fed's going to do with interest rates. This is a monthly chart looking at the price of the 30-year bond, which has been in a downtrend just based on price. And then on the bottom, we look at a ratio between the 30-year bond and the CRB index, showing that bonds are still outperforming on a longer-term basis when compared to commodities. Then we look at different sectors and compare them with the S&P, where materials are underperforming even though they've been bouncing back. Communication's been one of the stronger areas. It did see some weakness, but it's still in a longer-term uptrend. The energy sector is really underperforming the S&P 500. The financials have been chopping sideways, even though they have been able to manage getting into an uptrend when compared to the S&P. And we're watching this really closely. Industrials, they're showing some improvement here, but not quite enough yet to see a golden cross with this ratio. And the tech sector has been one of the stronger areas, but it has been pulling back over the last few days. Staples continue to be in a downtrend when compared to the S&P. Real estate, it's showing a little bit of an improvement as interest rates were coming down, and they started to show a bigger improvement as interest rates were falling last fall. But then when interest rates started to go back up, we saw this ratio really going down. Utilities, which continue to underperform the S&P. Here's a ratio that we look at. Typically, when this is going up, that means the S&P is outperforming utilities, and quite often that's what we see the index doing. When this is coming down, that's when the S&P is under pressure. It has fallen back, but overall, this ratio has been going up. We look at healthcare, which has really been underperforming the S&P. This next chart also shows how healthcare is in a downtrend on that with that ratio. Discretionary, this has been an area of disappointment. We want to see this doing better, but it's actually in a downtrend when compared to the S&P. That would really help the market. If this could turn and get into an uptrend, that would help the S&P to go higher. The staples sector, which is in an uptrend, which is kind of strange. This is usually more defensive. And if we're looking at a strong economy going forward, we wouldn't see a real solid uptrend like what we've been seeing now. We look at the tech sector, which has been one of the stronger areas. And then we look at the semiconductors, which really have been strong, even though they pulled back in Friday's session. This is a ratio between tech and the S&P, still in a solid uptrend. The energy sector has really been underperforming the tech sector. The energy sector outperformed in 2022, but since the earlier part of 2023, it's been really underperforming. And we look at growth stocks and compare them with bonds. This shows that stocks are outperforming bonds, another measure of that. The tech sector is also outperforming the rise in interest rates or the fall. This is showing how interest rates are underperforming the tech sector. Discretionary, even though it's being a disappointment when you compare it to the S&P, it's still having a tendency to outperform staples. Even though it's been pulling back and chopping sideways, it's still in a longer-term uptrend. Here's an inverse of that same chart showing how staples have been in a downtrend when compared to discretionary. Gold, which is really seeing a surge lately, it's actually ticking back up when you compare it to the S&P 500, but longer term, it's still in a downtrend when we compare the two. And with the fall in the dollar recently and the rise in gold, we're seeing this ratio starting to go back up and possibly even breaking out above this trend line. High leverage loans continue to do really well, and this is a very risky area of the market. And if the market was really concerned about the economy falling apart, we wouldn't see the solid uptrend that we've been seeing lately. The NYSE composite's one of the broad market measures that we look at, setting recent all-time highs and in an uptrend. All stocks looks at stocks in the US as well as internationally, also setting recent all-time highs and in an uptrend. Here's emerging markets, which are chopping more or less sideways, but they are in an uptrend. The Japanese Nikkei, that's their main index. It did surpass the highs set back in 1989. And this doesn't really impact the US market. It's more of a point of interest that I wanted to show you here, but they've been doing better lately. And here's the micro caps, the smaller companies, they're continuing to be in a longer term uptrend. Then we look at the housing market and we compare it with the S&P. We're looking for divergences or convergences here, and they're pretty much converging with each other. So we're not really getting any insight from this chart right now. Bitcoin setting all-time highs itself, breaking out and getting up into the 70,000 range. Then we look internationally where China is in an uptrend, but maybe rolling over. Emerging markets have also been in an uptrend. Europe's in an uptrend. Japan's in an uptrend. And we're pretty much flat, but we have been in an uptrend here in the US as well. Here's an intermarket analysis chart going back to the beginning of 2024, showing how oil has been doing the best, followed by stocks, then gold, then the dollar. But bonds based on price are still negative on the year. Some correlations. We look at the S&P 500 and the US dollar index. They're having a pretty strong tendency to go in opposite directions. So if stocks are up, generally the dollar is down and vice versa with that. That's why we watch the dollar during the day, or at least I do. Then we also look at the S&P 500 to oil, and they're having a pretty strong tendency to go in the same direction at the same time right now. We look at the S&P 500 to the 10-year yield, having a pretty strong tendency to go in opposite directions. So if interest rates are down, that's been giving some support to stocks going up. Here's tech to the 10-year yield, also fairly strong tendency to go in opposite directions. If interest rates are down, that's giving support to the tech sector. And then shorter term bonds based on the 2-year yield, there's a really solid relationship between the S&P 500 and the 2-year yield going in opposite directions right now. And you can see that on the chart. The S&P has been going up as the 2-year yield's been going down. Then we have some long-term secular, that means decades, versus cyclical studies that we look at. Cyclical just could be years. This is a monthly chart of the NYSE composite. We're above the moving average and it's going up. So that's positive in and of itself. On a momentum basis, as measured by the Copic curve, this is also looking positive. Then here's a daily chart of the NYSE composite, and we're showing a thing called the NYSE record high percent index, and this is also continuing to go up. This is looking positive. So we have a long-term look from this chart, and then a daily look on this chart, and they're confirming each other. Then we look at the S&P 500 monthly chart. It's above this moving average. And we have another momentum oscillator called the PPO that's also in an uptrend. So long-term, the S&P is still in an uptrend. And then we took a look at a ratio of the S&P 500 to the CRB index on a longer-term basis, also showing that stocks continue to outperform. Then we look at another global measurement of the S&P 500 to a global index, showing that the S&P 500 is outperforming. The KST is right on top of its moving average. If we see more strength in the S&P 500, this will probably cross over positive. But since this is a monthly chart, this can take quite a while to develop. Then at the very end of this video, I have a list of all those things that are positive. My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. So we have the growth indexes and the value indexes. When we look at them by themselves, copper is still in an uptrend, but it's been chopping sideways lately. The British pound and the euro when compared to the US dollar, gold, the big software companies, mega caps, the FANG index, as well as ARK, the low volatility ETF, the staples, the Dow Jones Composite Average, all the different bonds that we look at based on price are in uptrends. The tech sector, as well as semiconductors, the high leverage loans, the Dow, the NYSE composite, as well as the Wilshire. That's a new one that's just been added back to this list here. And the NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Even though the small caps and even micro caps have been underperforming, they're still in uptrends longer term. And then all stocks internationally, as well as within the US, emerging markets, and then right at the bottom there, we have Bitcoin, which is in a pretty solid uptrend. Then the last slide here is when I look at things that are negative, this is when the 50-period simple moving average is below the 200-period simple moving average. We have the US dollar index, which has been showing some weakness lately, but has also been in a longer-term downtrend. The CRB index, silver, and the Japanese yen when compared to the US dollar. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.